Hey guys, welcome to The Market is Open. Check out our website, themarketisopen.com. In this video, I'd like to go over the summary of a new research report and price target estimate for Tesla for Piper Sandler, which is now the street high, or the highest Tesla estimate on the street. Even Elon Musk responded to this price target increase, so let's have a look at what Piper Sandler says about Tesla. But before we begin, please hit the like button. We'd super appreciate that. And you can hit it at any time throughout this video. You can also hit the bell button to subscribe and be notified of upcoming Tesla content. And you can support us further on Patreon at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Alright, so Elon Musk replied wow to an overweight call by Piper Sandler as they lift their price target on Tesla stock from the $900 range to $2,322 per share. Now last week we also discussed Wedbush's price target increase on Tesla, but this was a bullish scenario price target. Their actual price target on Tesla stock was $1,250, which was well below where the stock was trading at the time. Now this report comes from Alexander Potter, who works for Piper Sandler, and I've actually watched some of his older videos. I believe they were all on Tesla Daily, and so I think he's very knowledgeable about Tesla. It seems like he's been itching for an excuse or a reason to raise Tesla's price target. That was my take after watching his interviews. As an analyst, you can't just make up a number based on a feeling or some qualitative measurement. These investment firms want to see tangible numbers and financial estimates and reports and breakdowns. So I think that's both positive and negative, perhaps. It's good because there's more rigor in the analysis, or at least there's supposed to be, in order to justify where you got each component of your estimate from. But at the same time, if you strongly believe in something and you see trends that justify it, that may not be enough to please these investment firms. And so I would say that most of these investment firms limit creativity, and there are times when thinking a little bit further into the future may benefit your stock picks. So I think Alex Potter is now able to put out this research report, which I feel like he's sort of had this for a while, but now the timing is right. Of course, these estimates need to fit into a 12-month price target, which is typical on Wall Street. If you think about ARK Invest and their 5-year target, that's not typically standard, but Cathie Wood can do whatever she wants with her firm, and looking 5 years out yields other perspectives and ideas. Alright, so the summary of this report starts off describing how Tesla stock has increased this year. Again, when you're looking at the stock market, as Jim Cramer always says, you don't care where a stock has been, you just care where it's going. Now, Piper Sandler is asking, should you sell your Tesla stock here? But they say no in capital letters. Alex Potter is betting on S&P 500 inclusion based on Q2 results. Of course, those are still unknown and we'll get them on July 22nd. However, regardless of those short-term results, Potter says that Tesla is one of the most consequential companies in the mobility ecosystem, and this is unlikely to change in the next decade. I would say wow to that. That's quite a bold statement. Maybe that's why Elon said wow as well. So they believe that Tesla will continue to be a leader for the next decade. You have to remember that all of these analysts on Wall Street and these money managers all have these financial models that they use. And so if you need to rethink your model, assuming that perhaps Tesla could in fact be a leader, or at least there's a higher percentage of them being a leader, then your valuations could change dramatically. And so he then gives a $2,300 plus price target, citing the fact that their discounted cash flow model reflected faster than expected share gains. And that's market share gains for Tesla, nothing to do with the share price. And more importantly, he is going to look at the software opportunity for this company. I don't know many analysts besides ARK Invest who have looked at Tesla's software opportunity. That's a high margin business and makes Tesla look more like a software company rather than a car company, something that a lot of bears have been saying. Tesla looks more like a car company with low margins, but in fact, Tesla could transition more into a software company, and that those will be reflected in the margins. Currently, Tesla sells their FSD, or full self-driving, as an add-on, and that's basically pure margin for Tesla. So one of the main summary points that Alex Potter says is that he says it's hard to see how competitors can catch up, and Tesla's own capacity is their biggest constraint. Now, our last video that we made highlighted Giga Berlin, which I think basically reinforces his argument here. I recommend you watch my Giga Berlin video, which I recorded after being up for 22 hours straight, so bear with me. But basically, Giga Berlin adds new capacity, and not only that, the capacity is producing cutting-edge vehicles using some of the new innovations that we talked about in the video that Tesla is planning to build into the Berlin factory, among some other key details as well. Now, moving along, Potter says that he sees an increase in 2020 delivery estimates, and that's this year, guys, remember that. Everyone was writing off this year, but Tesla is still shooting to break new records. He thinks the Tesla 500,000 estimate, that's actually Tesla's own estimate, in terms of deliveries, may still be in play. And that's key here because Tesla would need to deliver a crazy number of vehicles. We've actually talked about before. I said they would have to deliver 160,000 vehicles per quarter. That's just basic math. But if they even get close to that, then, you'll see in a second what kind of numbers he's talking here. Furthermore, looking ahead, Potter estimates 4 million deliveries in 2025. That would be impressive. I would like to see where these vehicles are coming from, like the breakdown in terms of each gigafactory. If they have 4 factories by then they need 1 million vehicles per factory. Currently, the capacity of each factory is closer to 500,000 vehicles, and it's going to take China and Giga Berlin a few years to actually reach that. Even Fremont's not really there yet. And that one's been around the longest, though it will be the least efficient factory. That said, the factories can continue to expand, so it is possible that they add 1 million vehicle capacity in total to each factory. Maybe not Fremont, but the other ones may very well be possible over time. Okay, so if this were the case, he says that this would imply a 7% market share in China and 9.5% market share in the United States. And there's some uncertainty in how this grows, but the trajectory is upward. He even references someone asking a question on the conference call who had the same number as he did. And likely we will get more information about this on Battery Day, which will likely be at the end of September. And that makes sense because Tesla is mainly battery constrained. So getting more batteries should allow them to produce more vehicles. And I also think that the share price shooting up gets people excited about Tesla. Certainly a lot of shareholders can actually afford a Tesla now, but also it creates a perception in people's minds that Tesla isn't going bankrupt or anything like that, which was all people heard last year. And Tesla's here to stay, and I think since it was all over the news, it's more free advertising for the company, believe it or not. Okay, now let's talk about software. So mid 20% operating margin is possible, he says. That would be pretty high. It looks like over the last year, Tesla's operating margin is closer to 3%. So moving that to 20% would be pretty insane. That would be similar to Apple's operating margin. So if you think about it, Apple sells hardware plus services. Of course, they make a ton of margin off the hardware as well. So I think Alex Potter is saying that, Tesla will also. And they'll supplement that with software or service sales as well, which will boost the operating income dramatically since it's all margin. So it's a big emphasis on software. He's raising his 12-month price target to 2,322 from 939. But okay, he says that Tesla could make 30% gross margins when they sell full self-driving. Currently, FSD is about 8,000 per vehicle. I believe he says 9,000. And about 40% or so, or less than half of the people who buy a Tesla also buy full self-driving. However, he assumes that the price of FSD will increase to $40,000 up from $9,000 over probably the next decade. You can also subscribe to it as well, which he believes will have a 125% increase over the price of full self-driving over time, and that will net Tesla more money over the long term. And I think this is in line with what Elon has said before. I think that price is only justified if there's no competition or if you can make money off of it by joining the Tesla network and using robotaxis to make money. And if that happens, then Tesla would have an additional revenue stream. I'm personally not throwing that into my estimates, and it doesn't look like he's adding it in either, the extra money from a Tesla network revenue stream. But $40,000 for full self-driving seems a bit high, especially if there is competition in the future. But anyway, he is saying that that's his 2030 estimate, but it is baked into his current price target according to his models. Now, Potter then says that Tesla could technically sell cars below cost and still have high margins due to software sales. I personally don't think that that's a great idea. That would be like Apple losing money on their phones just to make it back on the software. So I don't think that's too sustainable, and the company may become complacent. Like, oh, it doesn't really matter if we're cutting costs relentlessly because, we're going to lose money on the car anyway. We'll just make it back on the software. So that's almost like what the current automakers do right now. And it doesn't leave them much breathing room if something were to go wrong and you need to reduce prices even further. That said, it definitely would push competitors away and newcomers into the industry by making the barriers to entry extremely high. But I actually don't think that Tesla wants that. So in total, if we look at his actual estimates now, he increased his revenue this year to $30 billion, up from $28 billion. And for next year, he's kept it the same at an insane $57 billion. So I'd be interested to know why he has his revenue at double this year. The average estimate, I believe, is significantly lower than that. I think it's closer to 37 billion. And I don't think Tesla will double car deliveries next year. We may see 750,000 cars next year if we see 500,000 this year, which would be about a 50% increase. And Tesla will likely be selling them at a lower price, especially the Model Y, which I think will help this year due to the high-end versions being mainly sold. But then, as we saw with the Model 3, the prices will fall. So I think his revenue estimates might be a little bit out of line. However, with the kind of margins he's talking about, I don't think Tesla actually needs that much revenue to have high earnings, especially now that they're breaking even. So Piper's earnings estimates for this year jumped from $7.83 to $8.50 per share. The average estimate is about $4 per share, so he's about double the street's average. I think if Tesla comes close to 500,000 vehicles this year, then yes, that is possible. So let's think about this for a second, and just for fun, I want to see what the PE ratio of Tesla would be under different scenarios. So if the stock price stayed the same at around $1,500 as it is now, then if Tesla earns what the street forecasts, so $4 per share, then they'll trade at around 375 times earnings. Now it's a high number, but that number will drop as Tesla grows. And keep in mind that Tesla has never posted a full year of profit yet in its history, so these numbers are estimates, of course. Now, if we use Alex Potter's price target for this year, so in 6 months from now, Tesla earns about $8 per share, then you get a PE ratio of 187. Now, I actually consider that fairly cheap for Tesla's first calendar year of earnings, especially if you look at more mature companies like Netflix or Amazon trading over 100 times earnings and Tesla having larger earnings growth than either of those two companies. Okay, now what if the stock price rallied to his price target in 12 months from now? What would earnings look like? So for this year, the PE ratios would be high in my opinion, but for next year, and keep in mind that in 6 months from now, investors will start looking towards 2021 estimates, his $19 EPS estimate makes the stock actually look very cheap at 121 times earnings. Keep in mind though that $19 is a huge amount of money for Tesla to be making. But at 121 times earnings, even if the stock rallies to $2,300 per share. So I wouldn't say cheap, but cheap relative to Tesla's growth potential. And finally, if the stock goes to say $4,000, it would trade at 210 times earnings, which actually isn't unheard of, especially for a growth company in its early growth years. So there are some other metrics for the stock here, but overall, I think Potter has laid out a very bullish scenario. But if you think that Tesla could earn what he says, close to $8 per share this year, then that would fall much closer to Potter's price targets versus the street's price targets. So I think the upcoming quarter will give us some insights as to what Tesla's profitability and their leverage will be in terms of converting revenue into earnings. Now, I hope you enjoyed this video. Please hit the like button. We'd super appreciate that. You can also hit the bell button to subscribe and be notified of upcoming Tesla content. And join us on Patreon at patreon.com/themarketisopen, where we give a shout out to our patrons at the end of each video. Thanks so much for watching.